Hey, what's happening, everybody? Dan Darrow here from Options in Play. So today I am going to talk about sympathy trades. If you are a member of Options in Play, or if you're just new to the community, this is probably something you've heard me talk about a lot in the past. This is something I am always on the hunt for. Sympathy trades are they really arise for all sorts of different reasons. But what makes them unique from an options point of view is that the pricing of the contracts. Okay, and this is going to be something that you really won't see with equity trading. This is something that's very particular to options. So I'm always talking about it. I love talking about it. So let's jump into it here. Okay. So first things first, sympathy trade. All right. It revolves around spotting closely correlated stocks, all right, which we'll get into closely correlated in a second, but then figuring out an option strategy, a lower debit way or lower cost way to target that event, or say earnings or some sort of other significant catalyst. So it's finding a highly or closely correlated name, and then finding an option strategy that has a lower cost or lower debit way to target that event. All right. So correlation, that basically, at the heart of it, measures how closely two stocks move relative to one another. All right. So if one stock is up 1% and another stock is up 1% the exact same day, then that would be almost like a perfect correlation. So that'll be a 1.0, right? So if these things just move up and down every single day, just in tandem with each other, that's going to be a very, very high correlation. If they move completely opposite each other, so say, one stock is up 1%, the other one's down 1%, the next day the other one's up another 1%, the other one's down another 1%, right? So that's going to be a perfectly opposite or perfectly negative correlation. So that'll be a negative 1.0. So the highest possible correlation, 1.0, then the lowest possible correlation, which would be negative 1.0. All right. And when I do an example, you'll kind of see what I mean by that. Now, correlations can exist for a handful of different reasons, but oftentimes you'll see higher correlated names in same sectors, maybe like sub industries within those sectors, or maybe even like overlapping businesses, right? So for like sectors, say like financials, banks, right? Bank of America and J.P. Morgan, very similar. Maybe within transports, you see airlines, right? American Airlines, Delta, UAL, very, very similar, right? Those are going to be highly correlated names. Overlapping businesses, maybe like an Apple and an Apple supplier, like a Skyworks or a Broadcom, right? There's overlapping businesses, so the stocks can tend to move with one another, all right? So once you spot that correlation, what we just talked about, then comes the option strategy. All right, and like I first mentioned in the video, it's going to be short-term contracts because that's really like the way like these correlation trades tend to work out. A lot of these trades arise around earnings season, and because earnings season is really like a very big clustering of names within maybe like a 3 to 4 week stretch. The importance of weeklies really cannot be overstated here. Um, so what you want to do, or what I'm typically looking for, is say like a high impact catalyst or a high impact report, right? And then I'm looking for a closely correlated name, um, and one of those stocks. So that name that doesn't have earnings that week, or won't have the catalyst that week. So this will make a little bit more sense when I do the example. So again, looking at a stock or a company, say, that has like a big earnings report that week, right? This upcoming week, and then I'm looking for a closely correlated name that doesn't have earnings that week, or a big catalyst that week. All right, and the reason why is that the name with the big catalyst, okay, the options are going to have a higher implied volatility because of that catalyst, whereas the name that's very correlated, very highly correlated, and it doesn't have that catalyst, the implied volatility is going to be lower. all right? Because implied volatility gets juiced around events, around catalysts. So if the names are very closely correlated and tend to move with one another, right, then the name that doesn't have the catalyst should also move along with the name that does. But the implied volatility of those very short-term weekly options should be lower because they don't have that catalyst. All right, and I like to call this just basically catching a similar move at a cheaper cost. Right, and again, banks, retail, semis, right? A lot of these names will tend to respond to other peers in the sector when they report. So like these are just like classic areas where I'm always on the hunt for sympathy trades. All right. So let's go to example and hopefully can clear some of this up for you guys. So Kohl's, all right. I'm sure most of you guys are familiar with the brick and mortar names, the retailers, right? You have you know Kohl's, Macy's, Nordstrom, Walmart, Target, and so on and so forth, right? And the way that this normally plays out is that you tend to have a few that report early, or like so Macy's is usually one of the first names to report. Kohl's can often be one of the first names to report. Dillard's, another name. You can it's usually towards the beginning of retail earnings season. But the way it worked this quarter was that Macy's was scheduled to report 1 week, and Kohl's was scheduled to report the following week. So the Macy's options going into earnings were priced for about a 10% move, so a little bit under 10%, so like 9. Whereas the Kohl's options for that same week were only pricing in about 275. So 50 and change dollar stock. That's a little bit over 5%. Now the following week, right? The Kohl's options that went through its own earnings reports were looking for 5 points. Okay, so you can see the difference. Like the week that Macy's reports, the options on Kohl's were looking for about 275. The week that Kohl's reported for itself, they were pricing in about 5 points. All right. But what you'll notice is that Kohl's and Macy's are pretty highly correlated. Um, they tend to move with one another, which you can see here, right? I mean, just brick and mortar. I mean, like this is kind of like one of like those classic areas where I feel like people that follow the space they kind of already know that they move together. But even if you didn't, you can pull up a correlation calculator. Buyupside.com has a free one if you guys want to check that out. But this is a name, Kohl's, that was very highly correlated to Macy's. So you knew if Macy's was going to have a big move and it was pricing in about 10%, then odds were that Kohl's was going to have a big move, right? So the options that were pricing in 2.75 on Kohl's, there was a chance that those could end up being light because Macy's reported, and that's a pretty significant catalyst. It's like a early tell for that Kohl's report, right? So what happened was, let's go back to Macy's here. What you can see is, right, Macy's disappointed, a pretty bad report, right? And the stock itself actually got hit for about 3 points, so it ended up exceeding that price to move pretty sharply. What you also notice is that Kohl's, all right, so the options were only priced in at about 275, right? Closed about 51 and traded down to actually about 45 the next day. So it was about a 6 point move. So it was basically double the priced in move. All right. So what you can see is that had you waited for the actual report and played Kohl's, then there actually really wasn't a big move. But when you get these sympathy trades, right, you get the options. So you get the options at a relatively lower price because the implied volatility is not high because they don't have that catalyst premium, right? But then the Macy's report triggered a pretty sharp move in Kohl's because they're closely correlated, and those very short-term options ended up being significantly underpriced. All right. So it definitely requires a little bit more work, right? You gotta do a little bit more screening. It's not just like pulling up like the earnings calendar and seeing who's reporting. You gotta see who's reporting and then maybe dig into like names that could possibly move on top of that. But it can really be worth it sometimes because you get these scenarios where you get these names that will move pretty sharply with like the primary reporting company, but the options can really fall maybe at like a discount just because they don't contain that catalyst premium. All right. So lots to take in here, and you can obviously tell by my voice. I'm always excited about talking about sympathy trades because it's something that's very unique to options. Something that I'm always on the hunt for. Something that I really love to screen for. Um, so I hope you guys take a look. Maybe try some. Try some in the next coming upcoming earnings season. Put some on your radar. Maybe screen for some of these potentials, just because it's a really unique way to trade options, and a lot of times you can get those contracts at better prices without paying for like that catalyst. All right. So, any questions? Please don't hesitate to reach out. You know how to get in touch with me. Have a wonderful night, and I'll talk to you guys all soon.